Hey, everybody, and thank you for joining me once again for another edition of Magna Libra Trading and Research. Today's episode is entitled Who Cares? As always, a quick disclaimer: following podcast is for educational purposes only. This is not a solicitation to buy or sell commodity futures or options, and the risk of trading securities, futures, and options can be substantial and may not be appropriate for all listeners. All right, guys, we know we've had a busy week this week of the trading markets, and the risk is obviously off, and markets are full of volatility and in sell mode. But let's see exactly if we can try to make some sense of it all. And we know we're going to hear a lot about potential FOMC action and bailouts. We've already started to see that seed trying to be planted across some of the news outlets. But in reality, we have to look at like kind of where we're starting from. And we can't always rush to think about bailouts. And it always reminds us of this great video back from 2020 with, I believe it's 2020, with Chamath Palihapitiya on CNBC. Let's take a listen in here and listen to this video. We think it's one of the best ones that just kind of focuses on the reality of things when stuff kind of hits the fan. So let's take a look at this. And we found this on YouTube from an account called JamSF, but we've seen many other accounts post this. But let's just listen into this real quick.
You keep saying propping up zombie companies. Are you arguing to let airlines, for example, fail?
Yes,
Why? I mean, how does that make sense in the broader scheme of the economy?
because it's not, because when you look at what it means, this is why I'm saying, like, this is a lie that's been purported by Wall Street. When a company fails, it does not fire their employees. It goes through a packaged bankruptcy, right? If anything, what happens is the people who have the pensions inside those companies, the employees of these companies, end up owning more of the company. The people that get wiped out are the speculators that own the unsecured tranches of debt or the folks that own the equity. And by the way, those are the rules of the game. That's right, because these are the people that purport to be the most sophisticated investors in the world. They deserve to get wiped out. But the employees don't get wiped out. The pensions don't typically get wiped out.
Why does anybody? I just
that
understand. Why does anybody deserve, using your word, to get wiped out from a crisis created like this? How does anybody deserve to get wiped out?
Well, but just be clear, like, who are we talking about? We're talking about a hedge fund that serves a bunch of billionaire family offices. Who cares? Let them get wiped out. Who cares? They don't get to summer in the Hamptons. Who cares?
I mean,
But if you get
you
a
don't
clean
think the
cap table,
employees.
hold on, Scott.
You don't
If
think
you
the
get a
employees
clean
of these
cap table,
companies own stocks? I mean, own their stocks, own the company's stocks?
you can look on Bloomberg and you can see what percentage of these companies are typically owned by. These things are owned by BlackRock. These things are owned by these huge, amorphous organizations. Ultimately, downstream, and the employee owns a few $100s or a few thousand dollars of shares.
Well, I just don't understand.
So
This is like a natural disaster. Why does anybody deserve to get wiped out? Wouldn't that be immoral in and of itself?
No, because what's happening right now is what I'll tell you is on Main Street today, people are getting wiped out. And right now, rich CEOs are not, boards that had horrible governance are not, hedge funds are not, people are. 6 million people just this week alone basically saying, holy mackerel, I don't know how I'm going to make my own expenses for the next few weeks, days, months. So it's happening today to individual Americans. And what we've done is disproportionately prop up and protect, poor performing CEOs, companies, and boards. And you have to wash these people out.
So that's it. It's a great thing to listen to. We've posted it plenty of times, and Chamath Palihapitiya hits the nail right there on the head. And so we got to kind of keep in focus of like what's really going on in the financial markets here and who's really at full risk. When we look at moving on here to the Buffett indicator, anybody that looks at this and thinks that there's value embedded in nominal asset prices is not really, cognizant or fully understanding of the real risk that exists out there. We know over the last 30 years, the Federal Reserve has increased their balance sheet by an annualized rate of 9.8%. Now, many don't even know who the Federal Reserve, is or how they operate as a private company. But in reality, in the financial sphere, they're basically the enabler and the base money for all nominal asset prices. And they come to the rescue of the markets every time things start to fall, and then they increase their balance sheet, which leads to the next big cycle up. But you guys know that we've talked about for quite some time that Buffett's been selling since 2023, and he's accumulated close to 300, probably 350 billion in capital over that time. And we know he's the best value investor there is. So he's been selling for 2 years now. And when we look at this indicator, it's kind of hard to see from a retail perspective why you would continue to stay long and long only and not take profits. Now we know this is designed as a longer term objective for many, but let's not lose sight of the fact that losses can accumulate quickly, and stay there. We just haven't seen that in quite some time. But we know that the stock market is just one indicator of our economy, and it's actually an indicator for just a very small subset. So take a look at this chart here, this Buffett indicator, and realize where we're starting at. And honestly, generally we pull back quite a bit once we do turn around. And if we're up here and everyone's still long and staying long and thinking like this is like AI is going to solve all the problems, and nominal asset prices, no matter what our general economy does, continue to go higher, we could just tell you you're absolutely wrong. And this is going to collapse eventually. And will the Federal Reserve or the global central banks have the capacity or the bullets to save everything? We're not sure. We know there's a big regime change coming in regards to how things are being conducted at the administration level of our government, and that's going to transpire into the Federal Reserve and the global central banks and the monetary system in general. And that's why we are seeing big moves in gold. So these nominal asset prices and where they are at presently, even with this pullback that we've seen over the last week or two, this is just the start, guys. So we have to stay cognizant of where we're kind of at and where our starting points are. But in reality, the big thing is the tariffs are going to bring everything down, going to raise prices. But ultimately, there's a one group or subset of the population that owns all of this stuff. And the share of wealth is obviously, look at this chart here from visualcapitalist.com from 1989 to 2024. That's a 23 to 31 percent jump from 23% to 31%, the top 1% share of their wealth. So you're talking almost like, I think that's about 70%. I'm not just calculating at the top of my head, but that's a big, massive jump. Um, well, actually, not 70%, sorry, more like 40, 35 to 40%. But regardless, that jump is massive. And so in reality, this is who really gets affected by this, because all these nominal asset price gains are being concentrated at the very top. And even if you look here, the top 10% owns 87% of the stocks, guys. So when we see all of this, kind of transpiring and everyone's talking doom and gloom, well, we need to really focus in on who is really affected by this. And the amount of actual, wealth out there that's concentrated at this very top, not just the 1%, but let's just focus on this top 10%. They own 87% of the stock. So, is it really affecting the bottom 90% as much as the mainstream media tries to portend it being? And we're just not so sure that that's the right way to look at everything. Um, we feel that it's a fun thing to talk about, and what are the stocks doing, this and that, but then ultimately, it doesn't really, you know, on a daily basis, truly have the impact to the bottom 90% as it does the top 10%. So we got to kind of keep that in focus as well. So we just kind of wanted to point some of these things out there. And this is from Ritholtz Wealth Management, this chart. Um, who owns all of this stuff and who's really directly affected right at the forefront. Now, overall, if it starts to affect the overall economy and things start, job losses start to mount, and this is when we get that residual effect of kind of like markets and leverage getting purged. But ultimately, we believe that the tariffs and what the administration is doing is a good thing for the long run of this country, and we need to start normalizing kind of business and get things back to where is a more of a steady state in regards to beneficial for everybody, and not just for a certain country or other country. Because when we export our standard of living to import cheap goods, eventually that's going to hurt us, and we're starting to see some of that now, because you can't keep relying on this thought that we're manufacturing overseas because it's cheaper, and the big companies who are doing this labor arbitrage, yeah, they've made out, and that's who the Trump administration is trying to target, is this labor arbitrage. And ultimately, we think it's going to have to bring manufacturing back here. But we also believe that we need to start getting back to a more local logistics, operation because, if disaster hits or we have some sort of events that transpire when we're fully reliant on overseas and imports, then it's going to be problematic. So I think we're starting to see a big shift in the way America has functioned and is going to function in the future. So this kind of thing is kind of, this is revolutionary in regards to kind of how we're changing our system. So I'd be careful here for you guys that have this long only bias. I'm in for the long haul because things are changing, and for now the writing's on the wall. The market is repricing risk and readjusting nominal asset values, and we're not a big fan of kind of trying to pick the knife as it falls down here. So just be cognizant of what your goals are and your risk metrics are, and stay on top of this, what's going to transpire, because we think this is just the beginning. And here's another thing to look at too in regards to kind of overvaluation. This is from Tavi Costa and Crescat Capital. This is the Nasdaq 100 versus the money supply, and this is kind of like currently where we are now. This period here is the tech bubble in the 1999 2000, and look where we're at now. So I don't know, guys. Make of it what you will, but all I can tell you is that the risk here of owning here certainly doesn't outweigh the probability of you succeeding in buying up here and making superior gains. There's better levels to be found than where we're sitting right now. So don't let anybody tell you that it's a shame to take profits or to take capital off of the table, because as far as I know, in the trading world for the last over 2 decades, nobody went broke taking profits. So you don't always have to stay long because that's what everyone else does, and they give you it's in it for the long haul. Guys, the long haul has been predicated on QE from central banks and the zero interest rate environment, creating a financialized system that's dependent on low cost of funds for leverage. That system over the last 2 to 3 years has changed, and we need to recognize that change. So just know if you're staying long with knowing the historical levels that we're at are right here. And let's see what we're going to move on to here. Um, this is another thing that we saw. We talked about this back in 2022 when we saw this big jump post-COVID to these job openings that jumped here to this 12 million. We said this is all fake. How could we go from pre-COVID to top to around, almost near 8 million to then jump post-COVID up, up 50% higher to 12 million? We just thought this thing was fake. We just thought this is a lot of has to do with these jobs that come on these job markets like Indeed or LinkedIn or any of those zip recruiters that aren't really there but are showing that the economy's full of jobs. And we're like, no, this is fake. And we said this in 2022. All this thing is going to do when it tops out at 12 million is just going to go down. And look at now, it's gone straight down. So we kind of adjusted this chart to what we think the real data is, and we believe it more looks like this. This is what the real data suggests. Post-COVID, possibly got up to 9 million. Now we're back down here to where the real job openings are somewhere near 4 million mark and still declining. So, you got to be kind of aware of what the reality is of the numbers that everybody's putting out there, and kind of where you look at in reality what you're seeing in regards to out there in the real data and how it transpires. We knew that this chart was fake long ago, and we're just seeing confirmation of it now. But we were well ahead of the pack on that. But everyone calls you a conspiracy theorist or says you don't know anything. But you can go back to Magna Libra's writing in 2022, and we probably put this chart in here and saying this is going to come way down back when it was just making its top here. But we don't need to pat ourselves on the back. We know our data is correct, and we know that we're looking at the markets for what they are. And moving over now to kind of some of the FDIC data that we're seeing. Here's the quarterly net income, the latest quarterly net income. And you can see for us, higher rates is very beneficial to the market. Most people think higher rates to stop inflation, but in reality, higher rates are what bailed out the banks here, guys, because it allowed them to increase their net income. And when they're receiving 4.5%, 5.5% on short-term rates from government guaranteed funds, but only paying consumers out at 2%. You're talking about a 3% margin on trillions of dollars. And so what's that added up to is basically a stealth bailout over the last couple of years, and you can see it here. The banking net income last year was 268.2 billion, up 5.6%. So you can see over this return on assets line, this net income here is the return on assets is the blue line, but the net income here are these gold bars. So you kind of can see that, and here's the over here the value, the nominal value of it. But we've been outperforming here on the net income side with higher rates. But we should expect this as Fed funds is going to start to fall now, that this is now going to come back down. So this is going to be problematic for the banks. So their net interest margins are starting to get squeezed. So are their net interest margins, as the Federal Reserve starts to lower rates, starting to get squeezed? While simultaneously we're going to start to see defaults increase. This is going to be problematic for the banking sector, and we don't think many are, looking at it right now. But this is something you guys need to keep on your radar. So, we've kind of put that J.P. Morgan Chase out there, I think, chart this week as well, because we kind of figured it's topped out and below 220. It's going to become kind of obviously a negative bias here now, but. This is one of the things where we're not seeing yet in the banking sector their quarterly credit loss provisions jump. You see it here back in '08 to '09, topping out in 2010 here. Same thing here in COVID, and we haven't seen this jump yet, but my guess is we're going to start to see this kind of creep up. This is also going to continue to eat into the banking sector as well. Um, as far as this, we see this a lot on social media, these unrealized gains, and people posting like doom and gloom stuff, like, oh, the banks are getting killed or murdered, they're all these unrealized gains. But guys, it's just unrealized, and it's a mark to market based upon those higher rates that they're receiving on the forefront and gaining net income. And they have to show these booked mark to market losses on their portfolio because they own bonds that are yielding only 2%, let's say, but are now underwater because the short-term rate's 5%. So that's where this number comes from. But once the Federal Reserve lowers the Fed funds rates, we believe to 2.5% or lower, that these losses will evaporate. So this will help the banks out a little bit to offset some of that, margin squeeze. But ultimately, the lower rates are going to start to put pressure on the banks again. And when we look at J.P. Morgan Chase, this 226 level was pretty big in regards to the initial topping pattern and support, and it blew right through there. So we would suspect any backup here to 226 to be sold, and that the value area down here that we have marked in the green channel is kind of where our target level is for the bank. And who knows how far it can go if this, these credit losses start to add up, and the banks start to have to start provisioning more capital to that sector. Then we might even see it break this area and get back down into the 120, 130 area. But for now, JP Morgan and the rest of the banking sector is in a negative bias, and this is kind of the big dog. JPM is the big dog, so we would suspect everyone else to follow suit. So sell seems like sellers are in control here below 226 in JP Morgan. All right, so that's our initial rant, guys, of kind of where things are transpired. The risk is obviously heightened, volatility is heightened, but we want to make sure that we don't just focus on where we're starting out and where we're falling from. Yeah, JP Morgan's falling from 280 and now down to 210. Okay, so we get that, but ultimately, we don't want to focus on this loss here. We really don't think that that's where the intent really is. But a lot of people like to focus on that. Oh, the market's down 30% or JP Morgan's down 25%. But ultimately, no, we need to look at where it's going, not where it's been. We already know this. We just don't know this going forward. But we can tell where the risk is. And for us, the risk is to the downside. The risk isn't saying we've got more upside to go here, let's buy bottoms. No, obviously the trend is in here. The trend is lower. So let's recognize that and be cognizant of where the traders and the hedge funds and the fast money are going to be. They're going to be selling this stuff until the Federal Reserve decides to print more money. And we think we're far away from that. So a lot of risk to the downside here, guys, overall. And yeah, does that mean we're not going to get big pops and big S&P 200-day up days? No, that definitely doesn't mean that. Most likely, the more we get pounded down, we are going to get that big rip up. But ultimately, those rip ups are going to be sold because the trend is down. So that's kind of what we want to point out. So when we look at Friday's settlements, and we included Thursday settlements here because I think we misprinted this stacks down here, but we corrected it there. But you can see that the bond markets had a good week. Friday had a really good day, and the long end year to date's up 8%. So big move in the bond market there. In regards to the equities down here, you can see they just got pounded. S&P 500 lost 322 points, and Nasdaq down 1136. Dow down 2246. So big moves here in equities down lower. Surprisingly, Bitcoin did hold up with the US dollar, which is kind of funny. But that move is getting taken back here Sunday as we speak. And energies continue to get pounded here alongside gold. So some of the trade that's been long only for quite some time here in the energies and metals starting to back off here now. And we noticed that earlier this week too, as we believe silver and copper in our CTA market sentiment moved to neutrals. And gold most likely will this week if we stay below this, if we get below this 3,000 area, we might move that to neutral as well. But you can see the risk is heightened here, guys. When we look at the 5 and 30-day net changes, let's look at the big winners here. Over that time frame, you can see the bond market is obviously the long end of the bond market's actually up the most. So um, for almost 5 and 4% for the long end there. And the biggest loser here looks like the Nasdaq down up 15% over the last month. So equities, as you can see, double-digit declines here. Even nat gas, which was a big winner for most of the time, is down almost 14% over the last 30 days, with silver as well down 11. So, and the high flyer DAX is also down 10.5%. So you can see the losses starting to mount here, and the sell side starting to kick in, and which prompted us to looks like on our CT, as we said, our CTA market sentiment indicator obviously has the equity markets in a short bias. Now, this long one here for the ES is just an internal CTA Magna Libra proprietary metric that doesn't allow for all 5 components to go negative or all, in this regard. So that's the only reason why it's a +1. But ultimately, what this CTA market sentiment indicator is for, it's for the total sector. So you can see equities is a negative bias because all the components, 4 out of the 5, are in a negative bias. The bond market, 3 out of the 3 are +1, which means a long bias. So we look at this kind of like a sector kind of indicator. As far as the energies, all moving to neutral now. So everything's neutral there, and gold is the only one left with a long bias. Even though it got beat up on Friday, it's still in a long bias in regards to our proprietary indicators. But like we said, under 3,000, that might change here. So we'll see. So that's what we use this CTA market sentiment indicator for. It's kind of give us our long short bias in each one of the sectors that we follow, and gives it kind of just a simple binary +1 -1 metric, trying to not complicate everything in there. And then we tied a educational P&L with it too, if you guys are kind of keeping trading along in your own portfolios, kind of how we keep track of each one of these contracts. So it would be like just a one contract short, one contract long is kind of how we look at this P&L structure here. But ultimately, this CTR market sentiment indicator is simply for the bias of the each sector of the markets that we are following. And far as the bond market on Friday, we could see it was a nice little flattening here as the U.S. 30-year, the 30-year bond, it led the way down 9.6 basis points, with the shorter end dropping 5 and almost 6 basis points accordingly, the 2 years and 5 years. So a little bit of flattening, giving back quite a bit of the steepening the move that we've seen. This is the U.S. bond market. These are the durations: 2-year notes, 5-year notes, 10-year notes, and 30-year bond. So you basically go from short term to long term. That's what this means. And this is just the basis points up or down. Obviously, if we're dropping here in basis points, the bond market is moving higher, which is what you see here in price, because they move inversely. So we're trying to teach you guys a little bit how to look at everything as one, because we believe the whole markets function as one levered entity across every sector. And as artificial intelligence continues to weave its way through the financial market, we expect a lot more things to become tightly correlated to how one moves to the other. And we just think that's kind of the alpha will be driven to those that outperform and taken away from those that underperform. We believe that binary construct will continue to gain hold in the future. As far as looking at this yield curve, now here's one of the things that we like to point out. Back in March of 2023, you can see when we drop down to these lows here in regards to the yields across the board, Now we are seeing, yes, Friday, that the 2 year is now below that point, but the other sectors, the 5 year, 10 year, and 30 year, are not yet. So this is a nice, what's called a nice, this is steeper curve. This is a kind of a normal trajectory of duration risk in regards to how the bond market should normally distribute interest rate risk. It should be shorter at the short end and higher interest rate at the longer end. So we've seen a nice steepening and normalization of the US yield curve, as it was much flatter here and inverted back in March of 23. But now you can see, fast forward to April of 2025, we've got this nice shape here. So we know the 2 years below the prior low from 2023 there. The 5 year, 10 year, and 30s are not. So we will expect these yields to come down to match as the 2 year yield continues to move lower and force the Federal Reserve to cut short term interest rates. We expect longer term rates to follow this trajectory down here. So that's why I wanted to point that chart out. We also wanted to point out the Mega H tracker that our subscribers receive every day. You free guys will get this in the video at the end of the week, but this is our composite of the largest 8 stocks by market cap that we've started tracking back in 23, and because we figured that all these guys were getting all the capital, so we wanted to see when the market changed and started to divert money out of here. We started to see that in November of 2024 during and after the election, when money started flowing out of these stocks, kind of indicating that the top was already in. It took a couple months to transpire, but what that told us was that the big firms were already exiting as these high flyers were starting to underperform the broader market. So that was one of the good things why we pointed this out. We moved Tesla back in there before we had AVGO symbol, which is Broadcom, and those two have been battling out in the 8th spot. Berkshire Hathaway is the only up component year to date. Everything else is getting blasted, but like I said, we got to be cognizant of where we're starting from when we're looking at these percentage down, because they've all been high flyers coming a long way. But market cap wise on Friday, the grouping lost 878 billion. The Mega 8s dropped quite a bit in regards to this educational portfolio here of long only, and the hedge worked out pretty good for last week, which was the 43 call short. We will look again to sell the triple Q, or possibly just go long a put on any big up move. So that'll be determined, but that's why you need to become a subscriber. So if you do have long only portfolio structures like this, you can learn how to kind of hedge those out and protect yourself, because we think going forward, protection is going to offer you a little bit of protection. The hedges will offer you a little bit of a protection against these downside moves, against these long only portfolios, which generally most people are long only and expose themselves to extreme downside directional risk. And as you can see from, since we've keeping track as a educational P&L, this portfolio is down almost 20%, but the hedge side's only down 8.7 or 9% because of the options positions that we put on. So quite a bit. It's doing its job, guys, in regards to hedging out long only directional risk here. So that's why we keep track of this Mega 8s. In regards to the overall market cap chart, we're down now here at 14.5 trillion total from these Mega 8s, down 25% from this high up here, and below this 15,000 trillion support here. So we should get back up here and test this again, but this moving average, 21 period moving average, will continue to be the sell point on the way back up. But we do expect one of these times to get a big rip back up. Nothing goes straight down, as like nothing goes straight up, but generally we take the staircase up and the elevator down, which is what seems to be the case here. But ultimately, we believe the markets will give us a snapback chance to get short again. So you never want to really sell in the hole. That's never been a good strategy ever. So don't do it. In regards to where these things kind of are now from their market cap highs, you can see Tesla's obviously the biggest loser, down 50%, followed by AVGO, which is that Broadcom. That's down 41.5%, but all of them down well over 20% here, except for Berkshire. So you got down 20% and down 30% in some cases, down 40 and 50, and Berkshire's holding in just down 8, because that's obviously everyone was following Buffett, and since they hold so much cash, generally that was a little bit of a defensive move there to still own Berkshire. But even you know how a rising tide lifts all boats, the same thing goes with a lower tide. So everything's going to move lower no matter what. Now these percentages look big, guys, but overall in the big scheme of things, you know, we need to make sure we look at, and we'll look back in a couple technical charts in a minute here, but we need to look at kind of not where they are moving from, but where their potential is to move to. So this is also the stuff that our subscribers get every day. So hopefully you guys think about subscribing and getting a better understanding here of kind of the stuff that we delve into. And we also keep track of Strategy B, which was also known as MicroStrategy. This is the company that puts out convertible debt and converts it into and issues shares and converts them into Bitcoin holdings. So we love keeping track of stuff like this because mainstream media will start promoting it and has done so, and tout things like this. But we want to keep track of the data to make sure it's performing either good or bad. And lately, this covered call strategy is what we kind of track here. Has been basically flat for quite some time. It's gotten down pretty far, down almost above 25%, but now it's gotten back to up a little bit and then now flat. But ultimately, we expect the convergence of the premium that this stock trades at compared to its Bitcoin holdings can converge to zero, whereas right now it's about 1.78 x over its Bitcoin holdings, and that's what all the big hedge funds are trying to arb out. So let's keep track of this MicroStrategy for now. We obviously will sell the 10% or so out of the money call at the beginning of the week on Monday, and that's how we kind of keep track of this versus the outright long. It's a covered call strategy educational tool for you guys just to see kind of how this whole thing is progressing. But we've noticed volatility is dropping here quarter over quarter, which is not good for this stock. Because that's their basic product is exporting volatility to its investors. And if it doesn't have a lot of volatility or volatility decreases, then we would suspect the stock price to decrease as well. In regards to strategy B, once again, it tried to test our 316 level. It failed here, and failed here 3 times so far and move recycling back down. Ultimately, it's got to get above 315, 316 area to maintain a bullish stance, but below it risks it down to 230 here. So we're going to keep an eye on it. And ultimately, down to 196 is our real target reversal area that we feel it could get to sooner rather than later. So right now, the bears seem to be in control of strategy B. And in regards to Bitcoin, we added in the Gordon Gecko dump it to this chart because double failure here at our 89,150 level again. And breakout of this uptrend here, guys, is going to be problematic for Bitcoin. We suspect retail post ETF is probably losing money right now. They're dollar cost averaging. All the retail buyers that were coming in up here during the big ETF run up are probably right here at about 84, 85,000. They're not going to want to risk more than 15 to 20% on that, I bet, and they're going to dump their ETF holdings somewhere in this area and possibly test the strategy B, the company we just talked about, their dollar cost average, which is break even right here at 67,458. So ultimately, big hedge funds are probably levering up here to get this price down as well to kind of see how strategy B reacts. I know if we were a big multi-billion-dollar hedge fund, we would be employing this strategy to try and short Bitcoin here to get this down here to test these guys and see if we could push them to further the position. But that's what we believe, and most likely large hedge funds are looking at the same thing. All right, guys, let's move technical charts here. We're going to look at the triple Qs. You guys, we love this chart because this is a very technical based setup, triangle wedge breakout, and obviously you can see it's just gotten crushed ever since it broke through here at 504. Ultimately, 413 area is the prior, kind of near the prior top and prior breakout here and here from December 23 and back in November of 21. We're getting close to those levels, so we're going to expect buyers to come in here no matter what happens on Monday or tomorrow's trading. If we get a dip below here in the triple Qs, if they drop 25 points or something, we would expect buyers to come in here eventually all around here. So like I said, we don't think things are going to go straight, progress in a straight line. We'd rather sell tops up here back up to the 440, 450 area than to sell short in the hole here. But ultimately, this is how the technical picture breakout looks, and this is textbook here. You can see our value area down here for the triple Qs is here. Ultimately, we suspect once the economy deteriorates, we will get back down into these areas here. But you can see big moves here, like even the SPX, long way to go here, but we are topping out, and every equity index is saying the same thing, topping out. Regards to the Hang Seng here, this one's holding in much better because we know we're getting repatriation out of U.S. assets and into foreign assets, which is why the DAX has been outperforming alongside this Hang Seng because money's moving out of the U.S. and into these domestic markets, foreign domestic markets. So keep an eye on that. We expect this to continue the U.S. to underperform both the Hang Seng and the DAX as well. Looking at Bitcoin, like we said, we had that chart up there with strategy B. We continue to see it kind of under pressure here. So we'll see kind of over the long run where things go. But ultimately, guys, the big buy zone is down here at 38,000. We do expect it to get there at some point in time in the future. We just don't know when, and we don't care about all the ETF and all the Wall Street buying because ultimately it's all going to depend on our overall risk assets and who needs to sell. This is an accumulation asset and it's purely dependent on adoption rate. And we don't think more than 3% of the globe has adopted this thing in regards to a network utility function. Wall Street can parade it around all it wants and try to create the hype for it, but ultimately the adoption needs to come in regards to the environment for Bitcoin and its utility increasing, not just Wall Street adoption and levered purchases of it. Let's take a look here now at the 10-year. You guys know this 437 was a big level for us. We've held it back into our downward trend channel. We expect the 10-year yields to continue to fall. They may get a backup here once stocks do pop. We expect once the stocks to pop, yields will pop as well. But ultimately, both of those will reverse out as the trend now seems to be lower equity prices and lower yields. So keep an eye on the 10-year here. We'll probably move that 437 down at some point here, but it's going to have to trade into this 410 area for a while. But for right now, the downward trend is kind of our where we see things maintaining their status moving forward. And when we look at the 2-year, it's really coming down here and moving off of this high up here at about 500 was 5.26%, now down to 3.56. So a nice 270 basis point drop there. So 2.7%. Or sorry, 1.7% in regards to the drop there, 170 basis point drop. And now the Federal Reserve is going to get behind the ball here because the 2-year is outpacing on the downside with Fed funds at 4.25, and you've got a 2-year, let's say a 3.6. They're about 66 basis points, getting front run here by the 2-year to force that Fed funds down. Um, so yields definitely looking to break down here, which would mean risk is heightened and equities most likely going to continue to the downside and economic fundamentals going to continue to deteriorate. When we look over to the E-mini S&P 500, this 5121 area is pretty key. We're a little bit below it now, but this is a 38.2 fib retracement, but we expect buyers to step in here at least short term. Not to say that they're looking for a pop, but overall they're going to see value here once from this drop off here from the highs. They're going to see value here at 51.21. They'll see value here at 48.35 and ultimately down to 45.21. Where we think the real value is down here, but most people will step in right here for longer term purchases at this 51.21 level. We should get some decent buying here regards to the uh, S&P 500 futures there. Same thing for the NASDAQ here. This has gotten beat up quite a bit. It's below the 38.2 fib support and below our long-term trend line, which you see here, which is definitely negative bias. But like we said before, we don't want to generally sell in these holes. You got to wait for some pops, or else maybe buy some put structures to where you know your risk. But ultimately, we are going to get one of those bigger pops one of these days. But let's let this filter out and see. Maybe we do get a big flush down, but ultimately, I would rather buy this thing on an upturn than buy it here and catch a knife. So below 38.2 is not, you get these guys longer term buyers stepping in here, but ultimately, if you're a fast money trader, you're probably catching a knife down here. But so if you buy it here and you don't get that quick pop up, I suggest, we're going to see further downside probes. But ultimately, as you guys know, we don't like the Nasdaq versus the S&P. We prefer the S&P 500 over this Nasdaq. In regards, if you're going to play the long side, we'd rather play the long the S&P and short the Nasdaq kind of thing. What else do we want to show here? Oh, we can look at the Dow. You can see how the Dow is kind of holding up comparatively to the S&P 500 and the Nasdaq even. So these have been beaten up while those have been high flyers, so that's no surprise. And the same thing with the Russell 2000, making its way back into our major support band, which you see here in this area generally here. Ultimately, we will get back into this area, which would be a nice, decent buy zone initially for longer term investors. And kind of the Nikkei kind of keeps things into perspective as well. It's come a long way, but it's really not off the top very much, but it's just into our upper trend channel again. But ultimately, we start trading outside these bands, guys, then we can start looking at more of a longer term bearish picture and structural change in overall markets. If we get that, then obviously all bets are off. We don't know where this stuff can go if it does break through out here. Lots of structural changes will most likely have taken place, and we're really probably cutting down rates to zero at that point. All right, what else we want to look at here? Let's take a look at crude. Crude oil below 67 bucks is bearish. We expect it to get down to this 55 area eventually. Obviously not in a straight line, but when we look at this here, crude oil is bearish below 67 bucks. It took a while to get below this area. You can see how much of a support it was, 65 to 66 bucks, and now we're below it. So expect sellers to come in on any pops here in crude oil. And obviously, this is another indicator that the economy is not going to be doing so well in the future because it's getting discounted in energy prices, is what we're seeing here. In regards to, let's look at silver before we look at gold. You can see the big drop off in silver here. Obviously, this liquidation ruined about, let's see, how many weeks is this here? Let's see, go back to, yeah, early December. So about 5 months of work here in silver upside just liquidated in 1 week. So that's some panic selling there, guys. And obviously, when risk assets come off and people have to raise capital, they're going to sell whatever they can. And silver seems to be the recipient of that sell side. But we probably get support here around 29, kind of 29 bucks. If we get back above here, we can get a little bit of a back and fill here, but ultimately looks like the top is in here in the metals, and we can kind of see it in gold as well. We've talked about this upper trend channel that we've had here for quite some time, bouncing along it, and now we're back into this again. So anytime we get back into these, trend channels, the risk is always back down to the bottom of the base of this channel. So, can we get back to 2,800 bucks in gold? Sure, we can. So right now, gold is bearish as well. But ultimately, we get back above outside this trend channel, then we'll get back to the bullish bias. But for now, the sellers seem to be in control there as well. So sellers control across the board here. Um, let's take a look at now. Let's see. We'll move over to, let's just see Apple real quick. Just some of these stocks here that people are going to be like, oh, it's time to buy Apple. It's time to buy all these stocks now because they're down 25% from their highs or whatever. But ultimately, you can see the value band that we have is way well below. So when you look at Apple, let's not look at like where it started from on its highs, guys. Let's look at where it started from back in COVID. 78 bucks up to 270 or 260. Now we're just backing and filling, coming through some of the old prior tops here. Now we're below it. So basically our 220 now becomes kind of this area now. Resistance is 201. So this is a topping pattern. Sellers will come in most likely around this 200 bucks again. But ultimately, we don't see any upside here to buying this at this point. The risk is obviously for lower pricing and repricing down, possibly to 176 initially, but ultimately we'd like to see down here longer term. And will we get there? If you're patient, we'll see. If the economies do turn, we will continue down here. And there are all these tech high flyers saying the same thing. We can look at each and every one of them, and you can make the case for things getting really out of control and down here on the nominal pricing side. And ultimately, they all look this way. Microsoft looks that way. Alphabet looks this way. Amazon looks this way, and I don't care if they're 22 whatever it is times earnings or whatever it is. It doesn't matter. The nominal price is reflective of the current atmosphere of the emotions of the traders and investors at the time, and that emotion can lead to an overpricing or underpricing. So could we get a shot down here? Possibly. Over time, we will. But ultimately, guys, if you're looking to get long this stuff, you have to partition your risk out and either buy it on the way back up and do not pick the knives here unless you're willing to say, hey, I'm going to buy it at 170, I'm going to buy it at 140, and I'm going to buy it at 110. Like something like that. Like that's how you should look at this stuff as it gets discounted. You shouldn't be like, oh, I'm buying it here because it's down 25%. That's kind of silly. You have a plan, understand your risk, and if you love Amazon as a company and you want to spend $100 and buy some shares, well, buy $35 worth here, buy $35 worth here, and buy 30 bucks worth of it, down here at 120. That's kind of how you should treat these downside moves, because ultimately, yeah, equities generally reprice, economies recover, and the market moves its trend back up. But do you want to, buy it here, will put forth the full load? No, that's not the proper way to trade or do things. So we're just trying to create a mindset for you guys to kind of see where we think, you should enter and exit stuff based upon appropriate risk reward metrics. And even if you look at something like Netflix, like look at Netflix, I mean, you're going to buy it here because it's down at 200 bucks from its high, 20% from its high. Does that make sense when you look at the bigger picture? Like look at this move here. You could have said the same thing. Oh, I'm going to buy it here, back in January of 22. In November of 21, it got to 700 bucks, and then it got a big down move here, down to 530. Down what is that, 25%? close to 25%, drop from the highs, and then you bought here because you thought you were just buying it off the highs, and then look at boom, goes from 550 down to $162. So this is what we're talking about, guys. Be patient, have a plan, and understand your risk. I'd more, split things up into threes or fours, 25%, 25%, 25%, 25%. And then you can DCA or dollar cost average the whole way down, as opposed to picking up the knife and then saying, oh, I'm stuck, and getting maybe even stop yourself out. So longer term, you got to have those kind of plans, and that's kind of the mentality that we'd rather you go with. We already looked at JP Morgan, I think. We already looked at this chart, right? Yeah, risk down to 171 and back into this zone. Another chart we want to look at real quick, S&P 500 versus NASDAQ. We talked about this, why we'd rather be long the S&P 500 versus the NASDAQ, because the long-term confirmation of the bottom is in here. This thing's come a long way in a short time, but ultimately, this is just the bottom. We expect this contract to outperform steadily over the next year or two. So that's why we were saying we'd rather be long the S&P 500 versus the NASDAQ. And then when we take a look at this picture here, let's move to a line chart for this one. This is the 10-year versus the Fed funds, and now you can see when the Fed started cutting rates that that this spread started to move out of inversion, almost record inversion here at 154 basis points, and then got back up to 40 basis points positive. So almost a 200 basis point reversal here. But now the Federal Reserve is getting behind the ball again, and this curve's inverted. So this is where we're going to start to see. I don't know how far this can go. Maybe the 10-year can get to about 75 basis points negative here, and then the Fed will start to act. But ultimately, we'll see this thing go back up in positive fashion once the Federal Reserve starts to cut rates, and that is our trajectory. Even at the start of the year, when everyone said there was going to be maybe one Fed cut, we still opted for the 100 basis points this year, and we still think we'll get it. So we'll expect the 3 to 3.25 Fed funds to end out this year. But that's kind of what we want you to keep an eye on. The interest rate market and both will affect the equity markets as well. But this one's getting a little long here, guys. Sorry. Hope you guys have a good week. We'll be back with more for our subscribers every day. For you guys that haven't subscribed yet, hopefully this gives you a better understanding kind of the content that we put out, and kind of gives you our goal is to educate you on how these markets work, what drives them, and how monetary policy affects all of this. So stay positive, you guys. We want to try and keep you well informed and keep everything at your fingertips. So don't worry, start moving in the right direction, take hold of the reins, and stack the probabilities of success in your favor. Every little step matters. Every stumbling block that you overcome is a step in the right direction. So stay at it, guys, and never give up. All right, that's it.